What's next for Twitter stock and Elon Musk? That's the million-dollar question. Or if you're Elon Musk, it's the billion-dollar question, because if he backs out of the deal, he'll still be on the hook for a $1 billion breakup fee. Ouch. Hang out with me for the next 2 minutes and I'll break down what could possibly happen next for the deal to come together or fall apart. I'll also show you how to profit in the short term using call options and what I recommend instead for the long term. If you're ready to dive in, please go ahead and smash that subscribe button. I really appreciate your support. We can't move forward without first understanding what's already happened, so here's a really quick recap to get you guys up to speed. April 4th, Elon Musk says he has a huge stake in Twitter. The stock pops like fireworks on the 4th of July. Then he drops a bombshell saying he intends to buy all of Twitter, which is redonkulous. That led to a deal on April 25th, sending Twitter's stock price above $51 for the first time this year. Then on May 17th, Elon Musk said the Twitter deal was on hold in a public announcement that was ironically made with a tweet. This sent the stock price crashing back down into the 30s, and now we're all wondering what's next for Twitter stock and Elon Musk. Investors are going to be paying close attention to Elon's tweets and official Twitter comments to gauge the likelihood of the deal being completed. If it seems likely that the deal will go through between Twitter and Elon Musk, then Twitter's stock price is headed much higher in the short term. On the flip side, if the deal falls apart, then I'm afraid it's more pain ahead for Twitter shareholders. So let's start with the question, does Elon Musk try to back out of the deal or negotiate a better price? If he doesn't, then the deal simply goes through, but if he does, things get a little dicey. For instance, will regulators attempt to break up the deal? Will Elon's debt financing fall apart? Will he be able to prove that Twitter's business is significantly worse off than they led people to believe? If the answer to any of those questions is yes, then Elon Musk has an out and he could walk away from the deal. If not, then Twitter could sue Elon to force him to follow through. Now, if that scenario was to play out and Elon Musk wins the lawsuit, then he can obviously walk away from the deal. But if he loses the lawsuit, then the deal would have to be completed. There is a third possible outcome where the two sides settle by either completing the deal at a lower price or not completing the deal in exchange for Elon paying a hefty penalty to Twitter. That was a lot to take in, so now's the perfect time to stretch your finger and gently tap on the like button. So if you have a strong belief that this deal will in fact be completed, you can profit in the short term with a well-placed call option. Keep in mind that this is highly speculative, so please only use money that you are willing to lose. Call options are short-term trades, not long-term investments. Here's a quick example. Let's say you think Twitter could jump to over $50 a share by the end of the month. You'll want to check out the option chain for Twitter and you'll select call options. Call means you're betting on the price rising. Then you'll go out 1 month into June, which will be the expiration date. All option trades have expiration dates, so make sure you give yourself plenty of time. In this example, again, you have the belief that the deal will close by the end of May. Apply those filters, and then you'll look for a call option with a strike price in the mid-30s, which is where Twitter's stock price currently trades. For example, this one with a strike price of $37 means you're betting that Twitter will go higher than $37, in which case you'll make money. Lower than $37 and you'll lose your entire investment. Next, you want to look at the price to actually buy this call option. In this case, it's $3.50. Don't get too excited because you need to multiply that by 100, so it will actually cost you $350 to buy this option. Next, you need to understand your true break-even, which equals the strike price of $37 plus the cost of $3.50, which comes to $40.50. I know it's confusing, but that's how it is. Since you believe Twitter is going to 50, this is a great call option to make huge profit really quickly. In this example, you'd clear about $1,000 if Twitter stock went to 50 and you sold your call option at that point. That's a 285% return on your $350 investment. But what if you're wrong and Twitter stock never goes past your break-even point of $40.50? In this case, your losses are limited to what you put in, so you would lose the entire $350. That's the cool thing about call options. You can have crazy high upside potential while limiting your downside. Now, if you're a long-term investor and have no interest in using call options, then I recommend staying away from Twitter stock altogether. Instead, just buy the S&P 500 index fund or a total stock market index fund because that is the most effective and easiest way to build wealth over the long term. If you found this video useful, please like and subscribe. And as always, I want to help you guys out as much as I can. So here's my 5 easy investing rules. It's a completely free guide that I use before making any investment decision. Link in the description. Make sure you get your copy. And if you do decide to opt in, you'll be automatically subscribed to my weekly newsletter where I'll send you my top dividend stock pick of the week. I analyze thousands of stocks to find the one that not only is going to pay you a great dividend, but I also make sure that the dividend is safe and the company is rock solid. And I'll do this for you every single week, absolutely free, no strings attached. Now watch my next video and I'll see you there.